Hi, this is Joe Elsasser, President and founder of Covisum and also a practicing financial advisor. And welcome to another FinPlan Friday. Today's topic is actually a pretty frequently asked question of our support team here at Covisum, and that is, should a client ever do a Roth conversion if they don't have non-qualified money or non-IRA money to pay the taxes with? And the answer is definitely. There are times when people should do Roth conversions and pay the tax by using an extra withdrawal from the IRA. Now, what specifically are those times? The most frequent time to do this is in that window prior to age 70 and after the client's retirement, where you have complete control over how much you're withdrawing from an IRA account without having to worry about whether or not you're going to make Social Security benefits taxable. That's kind of a key window for doing Roth conversions. Now, if you have a situation where the client's living expenses can be met with a withdrawal that is less than the high end of one of the lower brackets, say for example the 12% bracket, and maybe once the client hits their required minimum distributions at age 72, they're going to be in the 22% bracket for the rest of their life. In that situation, we're definitely going to want to do some Roth conversions and get money out of that IRA as much as we can at the 12% bracket. And the way we would do that is by actually doing the conversion. And if you think about it this way, you're probably not doing any conversions at the beginning of a year unless we have, a terrible market dip like we did in 2020. That might make sense. But most of the time, most of your normal conversions are going to be happening in the fourth quarter of the year. And the reason is you'll want to make sure that no unforeseen income sources jump up and bite you, or unforeseen expenses that you have to take an extra withdrawal for. So you're going to be doing that conversion in the fourth quarter anyway. And what that means is that you've got until January 15th to make that tax payment. And if you're making the tax payment, you can take that withdrawal in the next year. And that way, by the time you roll to the next October, November, when you're doing conversions again, you just reduce the amount that you would have converted by the total withdrawn amount, both for income needs plus the tax on the prior year Roth conversion. Now, for those of you who are users of Income Insight, this whole process is automated for you. It's going to identify those situations where the tax on the conversion is less than whatever the target rate you choose. Maybe it's less than 12, or I guess through the 12% bracket or through the 22% bracket. And coming soon, you'll actually have the opportunity to specify the tax rate that you want to target. So thanks again for joining us for another FinPlan Friday, and we look forward to seeing you next month.